This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
Well, if climate change is real and we as a society know that we need to handle certain solutions, certain problems with solutions, rational economic actors are going to step in and say, I can make money off of that.
Hi, everyone. Frequent listeners know I'm always eager to learn about how climate investing needs to change to be more effective. With attacks on ESG and a new political era, we're clearly in a new chapter for climate investing. And being intentional about the ingredients, language, and goals of this new chapter is critical for delivering both solid returns and real impact. Rob Brown argues that it's time to step back from overreach and inauthentic impact goals and fuel this new chapter with rigor. Rob wears a couple of hats as Director of Climate Research at Resolution Investors and Chief Research Officer at Impact Evaluation Lab. In these roles, Rob brings his decades of investment experience using research and analysis to improve long-term thinking, risk management, and what he calls mission authenticity, or the ability to really deliver on the kind of impact one promises. I found this to be a deeply fascinating conversation about how climate investing is maturing and the work that still needs to be done for this new chapter. Enjoy. Hello, Rob. Welcome to Invested in Climate. Great to meet you and great to have you here with us today.
Jason, it's great to be with you as well. Thank you for having me. I'm looking forward to this.
Very good. Well, let's get started just by learning a bit about you. You're an economist and have worked with a variety of firms in financial services. Tell us a bit about the question that's driven you most throughout your career and some highlights of where it's taken you.
So first, Jason, I want to say thank you for that question. I've done this a bit, and there's always a question about, tell us about your career. I love the way you framed this as the question I've been in pursuit of. And I have to tell you, there's no one question that I've ever been pursuing, but it is the process of asking and answering a question that has always driven me. It's the research, it's the investigation, and it's ultimately the answer. You know, I was that dork in 8th and 9th grade calculus class who wanted to figure out how to solve a differential equation, right? Because I just love the idea that you can look at a problem, think about it, and then solve it. And I learned pretty quickly when I was in college that economics was a good framework for thinking about problems and trying to address questions. So that's what has ultimately driven me throughout my career. I started a professional life at an organization called Bankers Trust, which doesn't exist anymore. But at the time, they were probably the most sophisticated risk management shop out there. And we were building this toolkit we called it RAROC, but it was the risk-adjusted return on capital framework. And the economics team did a lot of work supporting that framework. We drove a lot of the input because, as you can imagine, as a big lender, you're kind of worried about what's going to happen in the economy. That was a short stint because I then got picked off by Morgan Stanley. And that's really when, as an economist, I was able to use my toolkit to help develop solutions for clients, first in the derivative space, and then overseas, doing more of that in the derivative space. But then the firm was pretty good about figuring out where they could utilize your skill set. You know, I was there reasonably early. I was employee number 2,800 and something. So they said, why don't you go run the global economics team? And from there, I just did a whole lot of good work with a lot of people who helped us do good work. And one thing led to the next. And now I'm an investor.
Fantastic. Thanks for the fast forward version. I'm sure there's lots of bumps and twists and turns along the way, but I love the twist on not necessarily being obsessed with the question, but instead the process and investigation and analysis itself. So you're wearing a couple of hats now. You are the director of climate research at Resolution Investors and also the chief research officer at Impact Evaluation Lab. Will you tell us a bit about those hats?
Yeah, I'd love to. And let me first say that, the passion that I've developed for impact investing is rooted in my very firm belief in what my parents taught me, which is that if you do one thing in this world, you should leave it a better place. And as a staunch advocate for capitalism and for deploying capital to empower people, I just think it's a wonderful place to operate. At the other end of that story I was telling you before, I eventually went to work for a guy named Paul Tudor Jones as head of research at an organization called Just Capital, and then started my own fund called Atlas Impact Partners, which was an impact hedge fund. And through that whole process of developing metrics and developing frameworks for thinking about the impact that a commercial organization can have on the world, I developed, I think, a perspective that informs both of the initiatives I'm involved with today. I left Atlas Impact Partners, became a fellow at the Sorensen Institute, and that's where I developed the methodology that we use at the Impact Evaluation Lab. So we're really thinking about how to evaluate a fund manager, how to assess the process that they go through. We call it mission authenticity. Some folks call it mission alignment, but we're really looking to uncover the level of seriousness, gravitas, with which a fund manager approaches the issue of impact, the resources that they deploy. We look at their what we call execution, which is their ability to actually deliver, report, and identify on the impact that they're creating. And then we also look to understand the connection between the financial return and the impact that they're delivering. All of that is the form of the work that we do at the Impact Evaluation Lab. And then we also have created a two-sided platform where asset owners can investigate the funds that are on our platform and figure out if they want to either potentially do some more due diligence or invest in them. So we're really trying to solve a secondary problem as well, which is early stage fund managers in particular, but I think many fund managers face this problem. They can't be found by the asset owners who are mission aligned with them. Asset owners, on the other hand, have a, let's say, problem that's on the other side of the coin, or a mirror image problem. They're constantly looking for places to deploy capital into, and they don't necessarily know where those fund managers are. So our hope is that we can bring those two sides of the equation together and ultimately drive more capital towards deserving solutions for some of the world's bigger problems. Now, Jason, the second endeavor that I'm involved in, which I'm passionate about and is probably even more directly relevant to our discussion today, is a firm in London called Resolution Investors, which is a long-only investment strategy in the equity markets that's focused singularly on the climate transition. And we really just think about the world in terms of three buckets of companies. Those companies that are seriously adapting their own footprint to a low carbon environment, and we're very rigorous and methodical about how we assess that. There are those companies that are creating solutions that you would define as adaptation. So how do we live in a slightly higher temperature world? And then there are more traditional mitigation strategies. So how do we think about reducing emissions and reducing the damage to the climate itself? And, we're a group of pretty wonky, I'd say highly research-oriented folks. We're a pretty wonky group of investors. We're pretty dedicated to deep research. 4 of my partners came from Generation Investment Management. They were all partners there. And then we have another one who came from one of the pod shops, one of the quant shops. So we've got a pretty carefully defined strategy, and we've got a carefully designed risk management toolkit that allows us to basically deliver a return profile that tries to get away from the volatility of previous climate investing cycles.
Rob, I'd love to double click on something that you said, is that one of the things that you do is you assess the level of seriousness of some of the impact goals of investors. And I think maybe that's a nice way to say that there's potentially a lot of investors or investment managers that have claims about the impact that they're creating that they aren't necessarily backing up with a rigorous approach. And you mentioned that you developed a methodology and an approach to assessing that seriousness. Tell us about it. How do you actually come in, and what's the diagnostics that you're able to do, and what are the actions from there?
Great question, Jason. We start with the idea that in order to understand what an investment manager is doing, you have to understand the investment process. You know, as I described to you, I've spent many years as an investor. My partner, founding partner, Terry Keeley, was head of the official institutions group at BlackRock. So he has a very strong sense of familiarity with what a due diligence process looks like because he's run them. And our third partner, Maren Keeley, ran her own media company in impact. So we all sort of understand what it means to run a business, to think about a business, and in particular to run a business that's focused on fund management. So we start with that idea. As an investor, how do you want to think about the process that this fund manager is going through? What we want to know is, for mission alignment, for mission authenticity, as we call it, is the firm equipped, first of all, to deliver on the promises that they've made to their LPs? Do they have the resources? Do they have the team expertise? Do they have the team commitment? Do they speak the same language across the entire firm? To me, one of the biggest signals you can get is when the impact team and the investment management team are saying the same thing or different things about the process. We want to know, more particular issues around impact itself, like are they measuring outcomes and outputs? Do they look at the breadth of impact as well as the depth of impact? Do they assess the outcome relative to an existing counterfactual? You know this, Jason, but there's a big difference between counting up the number of patients that have been served by a hospital and actually looking at the outcomes that have been achieved by different diagnostic tests that the hospital might be delivering for a certain disease. Those are two very different things. And too frequently, to your point, what we see is just a counting up of people served, what I sometimes call the McDonald's approach, 1 billion served. So what? What does the meal taste like? So that's our first approach, right? Is to understand the team, the resources they have, and the philosophical alignment between the team's investment strategy and the impact that they're hoping to achieve. Then we want to look at what we call impact execution, which is all around the specifics of their IMM framework. I think most of that would look very familiar to a lot of folks that might be listening to this call. And then the third thing that we look at is their financial performance. How are they structured, and what is their benchmark, and how have their returns been? And you put all those three things together and you do get our methodology. I think we also bring a very special and unique approach to applying that methodology, because we do put on our capital markets investor hat and we do run through a traditional due diligence process. We ask you, the fund manager, what are all of the documents that would support the claims that you just made? What are your answers to a certain set of 54 specific questions? And then we go back and we write a draft of what we think the fund performance is. We give that draft to the fund manager and we say, okay, now let's have a conversation. And we have 2 interviews, one with the portfolio management team, one with the impact team. And then we come back and we say, okay, do you think we got it right? Do you think the way that we evaluated you is correct? We then, if necessary, revise the draft if they can support the claims that they've made, the corrections that they want us to make. And that's essentially the process. I think what's most important about that process is how highly collaborative it is, because most of the fund managers that we deal with come back to us and say, I really got to tell you, thank you, you made me better. And that's what we're hoping for.
Rob, I imagine that many fund managers who just heard the long list of things that one might need to do and that you're excel at, and the response might be, sounds great, but that sounds expensive. Is this ultimately a cost center for firms, or are you able to show ROI for investing in this?
This is a great question that we love, Jason. I would first of all step back to our mission, right, which is to drive capital towards fund managers that deserve the capital. We do not view fund managers as a profit center for ourselves. So we charge cost, basically the hours that it takes us. We do have a standard fee, but it's a very, very reasonable fee relative to what some might consider to be our competitors. That's the first thing I'll say. Second thing I'll say, though, is that we have a subscription fee for asset owners who want to investigate the database of information that we have created. The way to think about it is simply that it's a two-sided marketplace, and we're trying to drive people towards one another. And that's the real value. So, yeah, you could look at us as a cost center, although I would say, again, as I mentioned, most of the funds we work for or with really do view us as value add because we're helping them be better.
Thanks, Rob. You've been in this space for some time, and you bring a level of analysis and rigor that I think should be really informative for this conversation. I'd love to focus on your perspective on climate investing today. Last fall, you published a piece in the magazine Institutional Investor. It was entitled, "What Sustainable Investors Got Wrong and Why It Is Still the Future of Finance." And it brings up a lot of interesting points that we should dive into. And let's get started with an excerpt that you wrote. It says, "What we found over the years is that so-called sustainable investing, when executed in the context of rigorous long-term financial thinking, works. What worries us is that people increasingly believe it does not because it has failed, but because it has been too often misguided." And Rob, this is a great quote, it's very intriguing. I think the key point is that you see a need for what you call rigorous long-term financial thinking. And pretty much all of our investors that I interview would say that's the kind of thinking that guides their investing. You're saying that's not often the case. Tell us about the problem you see.
Jason, the first thing I would say in response to that thoughtful question is you're interviewing people like Rob Day, Melissa Chung, Mark Berryman. That is not the entirety of the world. Those are people who are very serious about the work, who are very serious about both sides of the work as investors and as impact investors or impact proponents. So let's talk about the rest of the world. I don't want to confuse the people you're talking with to the rest of the world. And I think we have to be honest that there are a lot of folks who see the space of sustainable investing, impact investing, as an opportunity to gather assets. Fund managers who, frankly, think that it's a good idea to create a strategy off the back of an existing strategy by doing things like restricting themselves from investing in carbon-based energy, restricting themselves from investing in aluminum, overweighting perhaps a few tech companies because tech companies use a lot of renewable energy and they buy a lot of carbon credits, and then maybe placing a small bet on hydrogen because one day that might be successful. And then they go, see, now we have a new portfolio, we have a new strategy. The marketing team creates some nice charts that says, see how different we are from the benchmark, and then they sell it. I, as you can tell, have a lot of skepticism around that kind of process. But sadly, I think that's a lot of what gets represented as impact. Similarly, there are a lot of asset owners who were, frankly, sort of tourists in the space, who saw a theme, saw capital pushing up maybe some valuations and said, well, maybe I should have a piece of that, and made a small allocation into it. Those folks, I honestly believe in this environment are probably becoming less frequent and probably they're actors who are leaving the stage, which is fine by me and should be fine with your listeners, because what it gives us is a more consolidated sector that's truly focused on authentic impact investing and can probably deliver better returns over time.
Rob, your article provides a great and pretty quick timeline of the developments that led to sustainable investing as a space. Can I ask you to do a super quick version and give us some of the main milestones?
Yeah, sure. I always say that you could trace the history of sustainable investing and impact investing back to a farming operation and a conversation that a boss was having with his staff. And the boss turns to his staff and he says, "So listen, Moses, this is how I want you to behave. If you go to the Bible, if you go to Leviticus 23, you'll see that the Lord says to Moses, quote, when you reap the harvest of your land, you shall not completely remove the corner of your field, and you shall not gather up the gleanings of your harvest. You shall leave these for the poor person and for the stranger." That's how far back these concepts go. So let's be clear. There's a lot of space between that and 3,000 years later, when the Quakers were
yeah, you're gonna have to do a faster flyover than I even imagined. That's pretty far back.
But that's pretty far back. But the Quakers, I think, began conceptually thinking about a better way to invest. Let's call it that. In the mid 1800s, they had restrictions on slavery and on weapons. But if you really want to get to the modern day, you'd roll the clock forward another couple hundred years. And you'd look at least I would, 1977, when the Reverend Leon Sullivan, who was a Baptist minister on the board of General Motors, drafted what became the Sullivan Principles, which were a set of guidelines for GM, but then adopted by a dozen other major U.S. corporations as a way to behave in apartheid South Africa. That, of course, I won't say that began the apartheid movement, but that was at a time when the apartheid movement was beginning. Then you would go to probably 1987. The UN drafts the Brundtland Report, which was formerly called Our Common Future, which was really a roadmap for nations who are seeking a sustainable development roadmap. And I think that's an important inflection point because that became the Sustainable Development Goals, the SDGs. It's important to remember that those are really a set of guidelines for nations, not for companies, which is a little bit problematic today, even as we're trying to reinterpret them. But that, really is the framing for the modern day sustainable investing as we think about it today. Of course, in 2004, the IFC publishes Who Cares Wins. That's the first time we hear about, quote, ESG. And it was a risk mitigation idea at the IFC. What then becomes important to my mind is that same year, Generation Investment Management gets launched by Al Gore and David Blood. David Blood, of course, being the former, at that time, head of Goldman Sachs Asset Management. And that's the first time, it's a pivotal moment, because that's the first time that we shift the conversation from risk mitigation, we shift the conversation from restricting ourselves from doing things, and we pivot into return-seeking behavior. To me, that's where we should be constantly heading, is return-seeking impact investing. We could talk about other things like Just Capital, where I worked as the head of research back in 2014-15. That was a really, I think, important moment in time as well, because we're developing stakeholder capitalism. But I think everything that follows that is, as Rashi said, commentary.
So, Rob, where has it left us today? You describe sustainable finance infrastructure as deeply stressed. Where do you see climate investing today, and why do you call it, or as you say it, why can't it seem to move forward?
Yeah, I think it ties back to the comments we were making earlier, Jason, about the false actors in the field. And you could blame it on ESG. You could blame it on overenthusiasm from well-intentioned people. But it's pretty clear that there was a little bit of overreach. A lot of false promises that were made about intentionality, some performance promises that were made in the context of a zero interest rate environment that obviously couldn't be sustained. I might argue that the sustainable investing and the climate investing landscape today is no more or less stressed than the general VC private equity market. I think you can make a case for that pretty clearly. But where are we today? Well, let's first of all remember that in 2025, just in the United States alone, we invested something like $280 billion in clean energy. Yeah, there's some stress out there, and I believe it will be resolved. But let's also make sure we understand sustainable / climate investing isn't going anywhere. That's certain. The stresses that we see, I think, are largely around or a reflection of those issues that I just described. The pendulum swung pretty far to the left. The right reacted and pushed it awfully far to the right. And we're probably going to come back somewhere towards the middle. Last Friday, I was graciously invited to offer some comments at Wharton at their Sustainable Investing Conference, their annual convening of their program. And I made the point that we can't ever forget that climate investing is investing. And I think we forgot that for a little while. There were a lot of really well-intentioned actors who were proponents for deploying capital into things that, in hindsight, probably never really were economically viable. And that's okay. We did that, but let's move forward, find those viable solutions. As I said at Wharton, you can talk all you want about the pushback to climate, but JP Morgan just built 2.5 million square feet of net zero floor space. That's a hell of a commitment from the world's largest bank. It's also a statement that anyone who's concerned about investing should be paying attention to, because that's a lot of thermal pane glass. That's a lot of high-tech HVAC equipment. That's a lot of infrastructure that they're setting the stage to be bought in the future by others who are going to follow in their footsteps. And that's where I think sustainable/climate investing is headed.
Rob, let's go deeper into the statement that climate investing is investing and just needs to be thought of as that. And, this is within the scope of things that you list need to change, including a couple of big changes. The first of which is doing away with ESG as a standalone thing. I'm going to take editorial discretion and not dive into that rabbit hole of the ESG debate. It's interesting, but I actually find the second change that you propose to be more provocative. And you write that the goal of sustainable finance is simply maximizing long-term risk-adjusted returns. And I don't see mention of anything related to carbon or temperature rise or anything else we're accustomed to seeing for sustainable investing. So tell us more.
So despite what you hear coming out of Washington, D.C. and Palm Beach, Florida, climate change is real. Now, if climate change is real, the question then is, what's going to happen? And what I see happening is a lot of mitigation and adaptations, call them technologies, that are evolving and are becoming commercial enterprises. To my mind, that's the opportunity looking ahead. So if you are a smart investor, you might be wholly committed, as I am and my colleagues are. You might be wholly committed to adaptation and mitigation as a concept, but what you're really committed to is generating returns for your LPs. And those are some great sectors to be involved in if you understand the commercial aspects of the business. Some ideas, maybe not so much, right? I don't know. Does anybody really think hydrogen is going to be commercially viable in the next 5 years? I'd be hard pressed to say yes. But are there other sources of clean energy that are generating pretty nice financial returns? I would also say yes.
Rob, a focus on adaptation and resilience, of course, is important. It's not creating space within that thesis for mitigation and might overlook the enormous opportunity for an entire economy and energy sector that is in transformation. Does that fit into your model at all?
Oh, it does. Look, utility scale solar generates electricity that's depends on where you are, but call it somewhere well south of $100 a megawatt. Wind, well south of $100 a megawatt. That's if, depending on the price of energy, of carbon or natural gas, if you want to compare it, that's at worst the same cost as a natural gas turbine generated electricity plant, and probably a lot better. So I just think we have to reflect that as an accepted part of our energy infrastructure. And then the question about, does mitigation go away becomes a moot point. I don't think it does go away. I think it's part of where we are today.
Rob, let's go a bit deeper into some of the next steps that your article points to. It points to 6 tactical steps. We've limited time, so perhaps let's not go into all of them, but I'd love to get a sense of a couple of them that stand out most to you, or some of the most important things to think about as we go from thinking about high-level changes to tactical steps.
Jason, thank you. It's hard to say any two of those six recommendations are worth highlighting more or less, but I do think two stand out to me as sort of table stakes. One is that I do think it's really important that everyone extend their time horizon. That's nothing new, right? But the obsession around quarterly earnings on Wall Street is talked about, debated. It's a real thing. It's a real thing, not just for climate investors, but for everyone. But in particular for climate investors, you would do well to take a longer term view of the world and to take a longer term view of the earnings cycle that any commercial entity is likely to produce. We are seeing, if anything, an acceleration in the damage that climate change is causing, and we're seeing an acceleration in the response. That's great. That'll push forward some earnings to today, but make no mistake, the longer term is still highly profitable for a lot of firms. The second thing I would say is that you really have got to become a technology expert. If you're going to be in this field seriously, if you're going to dedicate LP capital to thinking about what are problems that need to be solved and what are the commercial solutions that will solve it, you can't be a tourist. You can't sort of understand the space. You can't sort of understand the trend. That is one of the problems that we have faced in the last two of the three green cycle investments. Green investing cycles. People got invested in the idea that hydrogen-based energy was a really cool thing. Prices ran up a little, and then everybody realized, oh, actually, that's not ready for prime time yet, is it? Those who understood the technology well understood there was a lot more work to be done before it became commercially viable. Similarly, I think if you wanted to really understand what's going on in the abilities of utilities to adapt their electricity, their power gen capabilities, you've got to understand the grid. And to do that, you've got to understand grid management technologies. And to understand that, you've really got to understand the software that manages the grid. You just can't be a good commercial investor by following a trend in this space. You've got to understand the technology. And that, by the way, is what we pride ourselves on doing at Resolution Investors. We are a deeply fundamental shop focused strictly on climate, and we are focused strictly on an earnings stream that is durable and that is long-lived and that can thrive through cycles. We've got a concentrated portfolio of positions, and each one of them we understand both from a financial perspective and a technology perspective as well as anyone.
Rob, you bring great insight to what needs to change, and without oversimplifying it, I go back to your argument about being more serious, that in some ways the space needs to grow up. It needs to become more rigorous. There needs to be less hand waving, less overpromising. How do we get there? Does it happen just as a natural result of people looking for real returns and better returns, and the market will get us there? When you talk about things like having a longer term view, that requires a different investment mentality and different types of patience. And so I'm curious, how do you actually see change rolling out to help the space mature?
You touched on a third issue, Jason, in the recommendations that we make in our institutional investor article, which is rigor. And I do think it's a critical aspect of success for any investment manager. Unfortunately, in the impact space in particular, and in the climate space specifically, there were a lot of so-called investments that were made in a theme, in a trend, and in a hope that weren't really scrutinized carefully enough. Now, those investments in the recent cycle were made in the context often of a zero interest rate environment, which meant people were much more willing to, quote, take a bet. As an investor, I would never take a bet, but sometimes people do, right? If your cost of capital is zero, then your risk tolerance is much higher. I will say that for the broad venture capital and private equity markets across all sectors, we're seeing the same phenomenon. It's not just the climate space that was suffering from a lack of rigor, but climate does suffer from a very severe set of criticisms that are unfortunately coming at it from a political angle. So those issues look like they're highlighted and look like they're specifically about climate investing, when really I would argue they're about venture capital and that whole infrastructure generally. But the thing that gets you through a difficult cycle like this, Jason, is rigor. The thing about rigor, though, is it, I frequently say I've learned three things over the years managing teams of investment professionals who are highly motivated and extremely intelligent. And that is the first, I'll tie this into the current point, but the first is that motivated people, highly motivated people, will act upon the incentives that you give them. The second thing is that a framework and rigor are really important to an investment process and to delivering on the expectations of your LPs. But the third thing, and probably the most important thing, is that just because you have a framework that is dependent upon rigorous data doesn't mean your investment thesis is valid. So you've got to have all three of those things. You got to have a framework, you got to have rigor, it's got to be relevant, and you've got to have professionals who are motivated in the right direction. And make no mistake, people who work for investment firms are motivated to deliver return. Nobody goes to work for an investment firm thinking I'm going to save the world. It may be part of your mindset, it may be who you are, it may define your values. But if you really truly wanted to, quote, just save the world, you'd go work for a nonprofit and you wouldn't be deploying capital.
Rob, despite the critique that you've made, and it's a strong one and interesting, you're actually quite optimistic about the future of sustainable finance. And I think that you wrote that you believe that sustainable investing and impact investments not only have a future within capital markets, that indeed they are the future of capital markets. So is it fair to presume that those 3 points that you described and the changes that you've listed, that you feel that we're on track to institutionalize those?
Yeah, I am. People who know me well, Jason, know that I'm cynical by nature. I'm also oddly optimistic by nature, right? My optimism is seen through a lens of specificity, right? Yeah, I do think that sustainable investing is the future because all of these issues that define broadly, generally, sustainable investing are addressing issues that are pertinent and relevant to the world today, and people are waking up to that idea, right? People are waking up to the idea that there's an alignment of interests here, and that's why it's such a compelling investment space. Going back to what I said earlier, climate change is real. You can deny it if you want, but the facts are pretty clear about that. Well, if climate change is real and we as a society know that we need to handle certain solutions, certain problems with solutions, rational economic actors are going to step in and say, I can make money off of that. I don't want to be so blunt and so maybe seemingly cold-hearted, but that's the beauty of a capitalist society, right? People will step in and figure out how to solve problems by creating a business. And that's why I think sustainable investing is where we need to be, because you can't run a business without healthy people, regardless of what business you're in. You can't, for example, run a business where temperatures are on average 100 degrees Fahrenheit and expect the people who are working in your factory or working in your warehouse can function efficiently without proper HVAC. So yeah, I do think the world is waking up to the idea that we need to treat ourselves better. And if we need to treat ourselves better, we should invest in it. And if we invest in it properly, we will be treating ourselves better.
Rob, thank you much for your time today, for sharing your insights and expertise, and all the best of luck this year.
Thank you, Jason.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.